In this lesson, we're going to learn what are stop loss and take profit orders. Why do the orders in the forex market make it a more secure market? What are the future orders of a limit and stop? Until when are the orders and directives valid, and how can they be validated? What is a breakaway gap? What is a rollover? Why does a transaction delay exist? Stop loss order. The meaning of this order is just as its name implies. The order cuts off our transaction at an exchange rate that was predetermined, or rather, it limits our loss, if there is one, to an amount which is known and determined in advance. For example, if we bought euros at a particular exchange rate and we placed a stop loss order of 100 pips below the exchange rate of purchase, we know that for this transaction we can only lose 100 pips. The advantages are, this order obliges us to make an orderly and timely plan for our position and to manage risks in advance. It prevents large losses and limits our loss to a maximal sum which is known in advance. It prevents the intervention of emotions, hunches, which may affect our decision. The order is put into action in a computerized and fixed manner, and it prevents the need to constantly follow our position. Stop loss makes the forex market the most secure market in the world. Let's assume that the exchange rate is 1.5220 and you think the rate will rise to 1.5320. If you want to gain 1,000 US dollars through a transaction of 100,000 euros but are not prepared to take the risk of more than $200, what are you going to do? Well, you pick up the phone and call the broker and request to buy me 100,000 euros and place a stop loss order at an exchange rate of 1.5200, 20 pips below the entry rate. In other words, if the exchange rate rises, great, you've gained. If the exchange rate falls and reaches 1.5200, the transaction will be closed at the moment the exchange rate reaches a rate determined by the order, and our loss will only be $200. Thanks to the stop loss order we have placed, we can rest assured and not lose more than what we allowed ourselves to lose. There is no channel of investment in which you can set your risk with absolute certainty. Consequently, we have another important advantage in the forex market: stop loss order. It is possible to determine the maximum risk in a transaction. We're going to learn more about this directive later. Here's a question for you. I have $1,000 in my account. Now, I bought 100,000 euros at an exchange rate of 1.5220. Now the rate fell by 120 pips. What will my position be? Well, it's very simple actually. In a transaction of 100,000 euros, every pip is worth $10, or rather 120 pips is equal to $1,200. Will the bank allow me to go below my level of collateral? Absolutely not. Remember, when you don't define a stop loss in a transaction, the stop loss is the sum of money that you have in your account with the broker. If you have no remaining collateral, the transaction will be immediately terminated. Therefore, it is important to place a stop loss order. Trailing stop. I want to teach you an interesting trading strategy. You have the ability to shift the stop loss, and with little risk, you are able to make a lot of money. The strategy is applied through a trailing stop. For example, you've entered a transaction of 100,000 euros, every pip worth $1 at 1.5220, and you've defined a stop loss at $50, which means that the transaction will be automatically closed at an exchange rate of 1.5170. If the exchange rate reaches the stop loss order rate, then we've lost $50. The next day, we perform another transaction, and again, we arrive at the stop loss limit. We've lost another $50. The day has finally come, and in the third transaction, the exchange rate begins to rise. By the end of the day, the exchange rate rose by 100 pips. Now, we can raise the stop loss limit to the point of entry. Now we lose no money in the transaction. We are now involved in a transaction with the potential of infinite profit with absolutely no risk. It will either fall back down to the original entry rate for which we set the stop loss at, or a rising trend will develop. What is a rising trend? while a rising trend is a situation in which the exchange rate begins to rise and rise. In the global financial market, there are always trends. Trends of 700 pips, 1,000 pips, or even more can be noticed. Now back to our story. The next day, the euro rises by 100 more pips. When it is 200 pips above the exchange rate of purchase, we can move the stop loss limit higher. It's very similar to wave surfing. As long as the wave is not ended, we don't get out of the water. If it is a transaction of 10,000 euros and each pip is worth $1, then a mediocre wave of 700 pips will give us a profit of $700. Or, if we hop on a bigger wave, we can profit $1,500 in a week or two with a risk of only $50. In many trading platforms, there is a trailing stop order, which means that there is an automatic trailing stop. You don't have to sit in front of the computer all the time. Such an order follows every movement of every pip in the market, and the stop adjusts itself accordingly. Take profit order. A take profit order is intended for a scenario in which a transaction is profitable and the changes in the exchange rate are reflecting increased profits. If a client is not interested in constantly following the transaction, but is rather interested in getting out of the market at a predetermined profit, all the client has to do is place a take profit at an exchange rate which is higher than the purchase rate, or rather, determine a monetary amount at which he or she would like to exit the transaction. For example, we've bought euros at a particular exchange rate and we placed a take profit order at 100 pips above the exchange rate of purchase. We know that in this specific transaction, we can only profit a maximum of 100 pips. These two orders do not entail any payment of commission. They can be placed at the beginning of the transaction, be changed in the course of the exchange, be moved or removed as long as they haven't been executed yet. It's important to note that there are brokers who allow you to place the order only after the transaction has been opened. On the other hand, there are brokers who allow you to place these orders at the beginning of the transaction. It's all subject to different firm policies. Future order, limit. Limit order. A limit order is a trade which allows a transaction to be performed at a better price than the current market price. For example, let's assume that the market price for the currency pair of euros to dollars currently stands at 1.3500. The trader expects the euro to rise up to 1.4000 in the long term, but in the short term, the trader believes that the value of the euro will decrease and is therefore not interested in buying the euro at the current price of 1.3500, but rather wants to wait it out for a small decrease until 1.3300 and then buy at a lower price. The limit order will be executed only when the price falls to 1.3300, on a condition that the exchange rate reaches this value, of course. Future order, stop. This order functions similarly to the limit order, but in the opposite direction. Utilization of this order is relatively rare, and a portion of the brokers do not even offer this option at all. For example, let's assume that the market price for trading of the currency pair euros to dollars stands at 1.3500. A purchase stop order would be set above 1.3800. A sale stop order would be set at below 1.3200. A trader can set a future stop order, which allows the trader, on the one hand, to enter the transaction in the direction of the market at the time when one of the limits is reached, 1.3800 or 1.3200, and, on the other hand, provides the trader the privilege of performing the transaction when he or she is not in front of the computer screen. One cancels the other order, or an OCO. An OCO order is a combination of the stop order and limit order for a future transaction. The trading platform follows the market for the trader and will execute stop and limit orders, but not both, at the moment in which the market arrives at a limit order or stop order. The order will be executed and the other order will be immediately canceled. The two orders are valid until they are canceled in one of the following scenarios. Good till cancel. The trade order is valid until it is canceled by the trader, who executes the cancellation through an order on an internet trading program or through a telephone conversation with their broker. Good till date. A trade order is valid until the date that is set by the trader. In other words, if by a certain date a trade order was not executed, it automatically gets canceled by the broker or by the trading program. Breakaway gap. In situations where there is a gap in the price or the areas in the graph in which there was no trading, most brokers cannot undertake to execute orders. In the case in which a client set an order and there was a breakaway gap, the broker will try to remove the trader from the transaction at the best available price. There are brokers who promise their clients realization of orders at a promised exchange rate under any market condition. Difference in interest rate between currencies. Rollover. Before we discuss this subject, it's necessary to note that most brokers perform a rollover in an automatic manner, and that there is no need for intervention by the trader. In order to understand the meaning of the rollover, one must know that the interest rate between countries is not identical and that they are determined by the local government from time to time as part of their monetary policy. Rollover interest is the interest paid or received for holding a position overnight. Every currency has its own interest rate, and because forex trade is conducted in currency pairs, every transaction contains not just two currencies, but also their interest rates. If the interest of the currency which you have bought is higher than the interest rate of the currency you have sold, you receive the rollover interest. That's called positive rollover. If the interest rate of the currency you have bought is lower than that of the currency you have sold, you will pay the rollover interest. That's called negative rollover. Rollover interest can add significant costs or profits to your trade. For example, when you buy the euro to dollar pair, you buy the euros and sell the dollars in order to pay for it. The interest in the euro block is 1%, and the interest rate in the United States is 1.5%. Since in this case, you bought the currency with a lower interest rate, you're going to pay the rollover interest of 0.50 on an annual basis. Conversely, if you sell the euro to dollar currency pair, you're going to pay the interest on the euro and you will gain the interest on the dollar. And you'll receive a rollover interest of 0.5%. The mathematical formula is this: 0.5% from the difference in the interest rates between the countries divided by 365 days multiplied by the transaction amount. Delays in execution or lack of execution of transactions. Such delays occur in the following cases: when economical data is publicized and there are problems in your internet connection, or when there is overloading of servers at the brokerage or the bank. Information that arrives at a delay of tenths of a second can be rejected. If you thought that the interbank system was perfect, think again. The interbank systems can also present a requote message. Bank systems can also experience rejection of transactions or partial execution of an order.